Today, we're going to go through the Backdoor Roth conversion Pro Rata Rule formula. So we're going to be able to figure out how much of the conversion was taxable versus not taxable. So we're going to start with the formula, and then I'm going to go through an example. Now, if you're not familiar with what the Pro Rata Rule is, it says that you need to take an equal ratio of pre-tax and after-tax dollars when you do the conversion, taxable versus not taxable. So here's how the formula works. So the Pro Rata Rule formula starts with the total basis. These are all of our after-tax dollars. Now, to understand basis, let me give you a quick example. Let's say that you bought a stock outside of your retirement plans for, say, $10. It grows to $15 and then you sell it. The original $10 that you bought it for, that is your basis because it's not taxable. The $5, that is the growth, and that will be subject to capital gains taxes. So our total basis is all of our after-tax dollars plus our non-deductible contributions. Now, these two are the same thing. The first one are just after-tax dollars that were contributed from previous years. And the second part is the amount that you contributed in the taxable year. We're going to take this total, our total basis, and we're going to divide that by the balances in all of our traditional SEP and simple IRAs as of December 31st at the end of the year. You cannot do it before. It has to be as of December 31st. Now, this only includes your IRAs. It does not include your spouse's IRAs, even if you're married filing jointly, just the ones that are in your name. It also does not include any other retirement plans, just your IRAs, and not your Roth IRAs, just your pre-tax IRAs. And also you have to include your distributions. So any distributions that you made in that taxable year, you're going to add that amount back on 12/31, and also your conversion. So if you converted an amount in the course of the year, you're going to add that back. Of course you did, because that's what we're doing this formula for. So now let's go ahead and go through an example so we can see how this all works. So here's the example. We're going to start with numbers on January 1st of that taxable year of a total IRA balance of $130,000. Now, there are no after-tax dollars as a part of this $130,000. It is 100% pre-tax dollars in this example. Over here on October 31st, it drops to $110,000. That same day, we made a $6,000 contribution and an after-tax contribution, also known as a non-deductible contribution, to your traditional IRA. That means our total balance at that point is $116,000. Then the following day on November 1st, we converted the $6,000. Fast forward to December 31st, our total IRA balances are now $105,000. So let's go ahead and add it up and go through some of this math. So we're going to add $105,000 to our $6,000 because this was our balance and this was the amount that was converted. We have no distributions. So 105 plus 6,000 is 111,000, and we're going to divide that by 6,000, which is our basis. Now, these two numbers just happen to be the same, but 6,000 is our basis. So 6,000 divided by 111. Let me go ahead and bring up our calculator. And I'm doing this on the calculator, and you should too, no matter how simple the math is. Go slow, write it out, take out a calculator. You'll make less mistakes. So we're going to do 6,000 divided by 111,000, and that is going to be 5.41%. So if we multiply that amount by our 6,000 to figure out which part of the 6,000 that was converted, how much of that was taxable versus not taxable. So if we multiply this 5.41%, multiply that by $6,000, that's going to give us $324.32. We round that out to $324. That is our after-tax amount of the $6,000 that was converted. So only $324 in the conversion was not taxable. So $324. That means the remaining amount, so we're going to do 6,000 minus $324. That means $5,676 gets added to your taxable income. So $5,676. Now, this doesn't mean that this just disappears and you don't get this benefit. It just means that it's still in your IRAs. And that amount gets tracked on Form 8606. So That is how you do all of the formula for the Pro Rata formula. But then we're also going to take a look at quickly at Form 8606 so you can see how this is tracked. But before we go on, I do want to point out that these dates and these numbers, this was irrelevant. I just wanted to give you a baseline of all the numbers that you're going to look at throughout the course of the year. The important one was the December 31st and the amount that was converted and how much your basis was. So how much after-tax dollars that you already had in your IRAs, which we didn't have any. So all of these amounts were irrelevant except this one, and obviously the amount that was converted. So I just wanted to show you all of the numbers so you can see everything that you're going to look at throughout the course of the year and realize, hey, not all of these numbers are going to help us with this formula and this calculation. So now let's go ahead and just quickly look at this Form 8606 so you can see how this works. So here's the 8606, and Part 1, you could see the non-deductible contributions. So those are the after-tax contributions to the traditional IRAs and distributions from your traditional SEP and simple IRAs. In Part 2, this is the conversion section. So this is where you report the amount that you converted from your traditional SEP and simple IRAs to your Roth IRA. So this form will be part of your taxes, and that is how you're going to track your non-deductible contributions and your non-deductible balances inside of your IRAs. So in future years, as you continue to do these conversions, then you can figure out which part is taxable versus not taxable. So that is how it all works. There are ways around it, different strategies, but we're going to save that for a different video. Of course, if you have any questions on this stuff, let me know in the comments down below. And if you've enjoyed this video, be sure to subscribe, and we'll see you on the next one.